This time, I'm going to talk about building economic growth forecasting model in Python. Recently, I read a paper by Harvey C.R. The title of the paper is Forecast of Economic Growth from the Bond and the Stock Markets. It's kind of relatively old. It was published in 1989. This is the paper I just mentioned. The author is Campbell R. Harvey, and I downloaded it from the internet, and you can download it as well and read it. In this paper, Harvey evaluated and compared the predictive power of the bond and stock markets regarding future real economic growth. In this paper, Harvey used the GNP, which I will discuss later. And based on the Irving Fisher theory that interest rates reflect the marginal value of income today relative to its value in the future. That's why we can forecast the economic growth based on the interest rate. Asset prices are forward-looking. Bond yields and stock returns should theoretically contain information about the future path of the economy. And so Harvey developed 4 distinct forecasting models to evaluate their ability to match actual GNP growth against forecasted projections. When Harvey published this paper, it was in 1989. So this time, I analyzed with Harvey's theory and using the data from 1962 to 2025. And I used the same long-term bond yield spread and SP 500 return, just like Harvey did in his paper, and compared my results with his results. The first question when I read the paper is why Harvey used GNP instead of GDP. So I just compared GDP versus GNP. I will not read through all those comparison items, but if we look at the formula, the GDP equal to consumption plus investment plus government spending plus exports minus imports. Then when we calculate GNP, it was based on GDP plus net income from abroad. So that means it's income earned by residents abroad minus income earned by foreigner domestically. So from this formula, we can see the GNP can be greater than GDP or can be less than GDP. Depends on if this negative income from abroad is positive or negative. Harvey didn't explain why he used the GNP instead of GDP for his model. What I'm thinking is maybe he is thinking, okay, we should consider the net income from abroad for certain country to measure the economic growth. So I use GNP2 for my model. In this way, I can compare my results with Harvey's results. In Harvey's paper, he said, during expected downturns, investors purchase long-term bonds as insurance or hedge, bidding up prices and lower yields, which causes the yield curve to flatten or invert. I think a lot of people know this phenomenon. Before several economic crises in the US, a lot of investors noticed the yield curve inverted. And equity prices represents the discounted value of expected future cash flows. Therefore, price change should reflect revisions in growth expectations. Harvey said, although the stock market is commonly viewed as a leading indicator, changes in how investors perceive risk can blur its signals and produce false recession warnings. That means if we forecast the economic growth based on the stock market signal, we will get more recession signals than the actual recessions. Now, let me explain the methodology and the forecasting model. In Harvey's paper, he used this linear model. Of course, in order to compare my results with Harvey's results, I will use the same linear model. This item means growth measured over a future period from time t plus 1 to t plus 5. And A means baseline level of growth. And this B is the slope coefficient of future growth. And this item is the error term. For the growth, we will use annual algorithmic growth in real GNP. And this X is a predictor. And we are going to use 4 types of variables. One is 5-year yield spread, 2, 10-year yield spread, and 3, stock returns for 1 quarter and stock returns for 4 quarters. Now, let's go to the Python model I built and check out the results. I downloaded the bond yield and the stock price from the internet, so you can do the same thing, and I will upload those data file I used and also my Python code to my GitHub, so you are welcome to download it and maybe modify my model and run it by yourself. And also I downloaded the GNP data. Now let's calculate all those yield spread. First, I will load the data. Then I will compute year-over-year GNP growth, and I will load and clean 3 months treasury bill data. And here, if we take a look at the GNP, because this is not like the stock market price or bond yield, which are available every day. The GNP data are only available every quarter. So I will convert monthly or daily data to quarter start dates. And I will load long-term yields, and here we only use close prices. And you can see this is the function to plot yield spread, and this is function to generate the graph. Here I load and aggregate S&P 500 close prices and also convert it to quarterly close. And then I'll plot lagged 1 quarter returns. Here plot lagged 4 quarter returns. Now let's run our model. You can see here we have annual GNP growth and lagged 4-year yield spread. You can see the blue line is actual GNP growth, like this, and lagged 4-year yield spread, the red line. We are going to check if this lagged 5-year yield spread is running ahead of actual GNP growth. That means with this yield spread we can predict GNP growth. You see here it looks like a little bit ahead of the blue line, which is the annual GNP growth, but it's hard to tell. If we check this 10-year yield spread against annual GNP growth, we can see the similar phenomena. We want to see the red line, the running ahead of this blue line. Here, maybe we can say it's running ahead. It can provide some prediction of this annual GNP growth. And when we check this 1 quarter return on S&P 500, we can see it's a lot of signal here. It's very hard to tell. And also 4 quarter return on S&P 500, and it is less volatile, but still a lot of signal. Okay, now we are going to build our forecast model to check the result. First, I'm going to load and clean long-term treasury yield data. Also, I'm going to use only the close prices. And similarly, I'll convert dates to quarter start format for alignment, and load the GNP and the 3-month treasury bill. And here, I build a function for OLS and rolling OLS. So OLS will be used to build our model, because we only have a linear model to calculate A and B. And for prediction, I'm going to use this rolling OLS. And I'll load S&P 500 datasets, and then I'll compute future GNP log growth. And here I'm going to construct predictor variable yield spread or S&P 500 log returns. Here I'm going to plot our forecast GNP growth against actual GNP growth to compare. And lastly, I'm going to evaluate our forecast accuracy using classification matrix. Okay, this is our main function. It will call all those functions I mentioned and calculate matrix at the end. Now let's run our forecast model. Okay, here you can see at the very beginning we only have actual GNP growth, this blue line, and after 10 years we will start our prediction. The prediction looks like this. You can see our forecasting is less volatile than the actual data. How about we use 10-year yield spread? This is 10-year yield spread if we want to compare. They change a little bit but not much. And if we use S&P 500, only have 1/4 lagged return. You can see the prediction looks like this. And how about lagged 4/4 return? You can see this is lagged 1/4, lagged 4/4. Obviously, this is more smoother than the lagged 1/4 return. Now, let's compare our forecasting results with the actual GNP growth. Here, I'm going to use the second derivative to compare. That means if this curve goes up and our forecast curve also goes up, that means the economy is accelerating growth. We'll say it's correct. If the actual GNP comes down and also our forecast GNP also comes down, like here, that means the economy is cooling down. And then we'll say our model is correct. You can see I show the results here. I just put those results, those metrics, in my slide so it will look better. Now let's go to our slide. About the matrix I used in this model, if you are not familiar with precision or recall or F1 score, you can watch my previous video, Tuning Support Vector Machine in Python, and I explained all those concepts in detail. In this model, for the 5-year yield spread and 10-year yield spread, we got 0.5055, 0.5236 respectively. And for the lagged 1/4 return or 4/4 return on S&P 500, we got F1 score 0.5510 and 0.5300 respectively. So for my model, the results for the economic growth forecasting, if we use S&P 500, it will produce more accurate prediction than use the 5-year yield spread or 10-year yield spread. As I mentioned at the beginning, in this paper, Harvey said models using yield spread are significantly more accurate at forecasting actual GNP growth than stock-based models. But in my model, I couldn't verify harvest result, including the accuracy of forecasting GNP growth or the significant differences between the yield spread-based model and the stock-based model. I think this may be due to variation in datasets, time period, or other factors. In general, economic growth in a country is influenced by numerous factors, making it hard to believe that bond yields or stock indexes capture the majority of the key determinants. As I mentioned before, I've uploaded my Python code and also my datasets to my GitHub. You're welcome to download the data and modify my model and produce some new results. And if you get your new results, you're welcome to provide your results in my comment section. This is how you can build an economic growth forecast model in Python. Please provide your comments and subscribe to my YouTube channel. Thank you.